you'd call your broker and say, I'm looking at the interest rates, and I don't want my money in my savings account anymore. At that interest rate, I'd rather be in my checking account. So I want to sell my Treasury security.
This is the MMT Podcast with Patricia Pino and Christian Riley.
Are we on camera?
Yeah, we're on camera. Okay, so we were kind of discussing this last night. So obviously in the MMT view, QE is like a transfer between reserves and bonds. So some bonds get transferred back into reserves. Is that right?
Well, it's a reserve is the Federal Reserve, and the central bank is a bank. So it has deposits like any other bank, and they have two types of deposits. They have overnight transactions deposits, and then they have time deposits. So a normal bank would call it a checking account and a savings account, or a checking account and a time deposit, or a CD or something. The Federal Reserve calls it a reserve account instead of a checking account, Federal Reserve Bank, and a Treasury security. They call it securities account. Okay, but it's functionally identical to a checking account and a savings account in a normal bank. So when they do quantitative easing, what they do is you've got money in a savings account. They say, at what price would you like to not have a savings account and transfer your money back to your checking account? And you say, okay, it's 1.71% interest. I'll do that. And they say, fine. Now they do it through a broker. And so you don't even know they're doing it. You would actually initiate it. You'd call your broker and say, I'm looking at the interest rates, and I don't want my money in my savings account anymore. At that interest rate, I'd rather be in my checking account. So I want to sell my Treasury security and get paid. And then it just happens to be the central bank on the other side. But if it was Citibank or Barclays, it wouldn't make any difference. Thank you. So the effect on the economy would be the same as if Citibank went to its savings depositors and said, at what rate would you like to switch to would you rather have a checking than a savings? And they put a rate on it, and they said, okay, and they switched them. So the fact that it's a central bank isn't particularly consequential.
But in the process, in the QE, as I understand it, the existing securities were bought off the private sector. So does that imply that actually new bank deposits are created as well?
Bonds, your Treasury securities were already bank deposits. Those are deposits at the central bank that are time deposits that pay a certain interest rate. It's a deposit. So you've shifted your deposit from one type of account to another, from like a savings account to a checking account at the central bank.
Right, but when you're when the security is being bought off the private sector, there's a reserve inflow to the commercial bank that they use, and that presumably then creates a deposit for them as well, because there's a reserve inflow creates a deposit.
Somebody in the private sector sells their securities account, their Treasury securities. Okay. And let's say your bank is Barclays. Okay, so your securities account will be debited at the Fed, okay? And they will credit the reserve account of Barclays, and then Barclays will further credit your checking account, okay, at Barclays. So your money your pounds have now shifted from being in a Treasury security to being in a checking account at Barclays. Now has a match. They have reserve and they have you. They have an asset and a liability.
But how then does sort of QE have this effect of increasing value in the stock market? What's the sort of
There's no channel. There is no channel per se. It's entirely a placebo effect where people believe it might help, so they might act differently, their valuations might change. But the other thing is that people take it as a signal that the central bank is committed to lower rates, and so it's just an adjustment to lower rates. Now, the other interesting thing is they say it's inflating asset prices. But what I would say is the normal asset price, or the base case for asset prices, is with a zero rate. And so they're just returning it to the base case of where an asset price would be if with a zero rate policy. If they raise rates, then they're depressing asset prices for some political purpose. So Japan's had zero rates now for 30 years, and there might have been a one-time adjustment in asset prices, but they don't just go up forever. The Japanese stock market's not doing anything particularly exciting. It's back to where it's half of where it was, in 1989 or something like that. So, and they've had zero rates and QE and everything else for 30 years. So,
You're saying there's no substantive cause and effect relationship between QE and asset price bubbles in the stock market and commodities?
no financial channels.
It's just an atmosphere. Or
Well, to the extent that rates are coming down, which oftentimes happens in the context of the central bank lowering rates, then you've got to adjust asset prices to the new rate. Yeah, but that's a one-time adjustment. That's not inflation.
everyone says that we're talking about bubbles, but you're saying this is the true price.
The true price action. I mean, you still can get bubbles. We had bubbles when rates were 8%, when rates were 1%. We haven't really had them when the rates are 1%. All the bubbles have come when the rates are 5 or 6 or 7%. Japan hasn't had an asset bubble, and they've had zero rates for a long time. Europe hasn't had one with zero rates. So, I don't think you get. I haven't seen asset bubbles associated with low rates. Even though that's the. I'm not saying it can't happen. I just haven't seen it. So look at an 08. Rates were Fed funds were 5.5%. Right?
Is QE any different from regular open market operations? Except when you're at the when you're going for a zero interest rate, the logical consequence of that is you have to buy more.
No, you don't buy more. You see. Once the banks have, $1 or £1 in excess reserves, the rate will go to zero. You don't buy more. What you do is you're just pricing what the cost of funds is to the bank. So once you've established a zero marginal cost, that's fine. Now, if you want to change it, you don't have to remove reserves. You just raise the price on it. So they do interest on reserves or something like that. And so they're not adding and subtracting reserves to change the rate. They're always adding and subtracting reserves just to offset operating costs. But the price they put on them, what's called the stop on the repo or the interest on reserves, that's what determines the rate. It's always price, not quantity. It's always about price.
So what convinces people to sell their treasuries and shift into cash?
Okay, so
What do you have to offer someone to do that?
in 2012, Mario Draghi said we're going to do quantitative easing and we're going to go to negative rates. And the Bank of China says, no, I'm not. This is my stylized comment of how I think it went down. The Bank of China says, don't you dare do that. We'll sell all our euro securities and get out of euro reserves. We're not going to let you hyperinflate our holdings away. And Draghi says, okay. So he does quantitative easing and negative rates, and China sells the reserves. And they dropped, the euro went down almost, 30-40% from 145 to the dollar to 100 maybe, or 105 or something. Nobody even cared. Everybody says, what happens if your currency collapses? Well, there's an example. Nobody even cared. Okay? And there wasn't any inflation. All right? And Draghi was just, and the Bank of China was just wrong.
I've read that in the long run, it makes more sense. It's more helpful for a bank to have treasuries than to have cash for various reasons, which I don't remember. So how can you convince them to sell their treasuries for cash?
Well, banks usually don't hold them anyway. It's usually their clients. But it's just a question of price. If you want to buy treasuries, you got to buy them from somebody. So, there's always a buyer and a seller at a very tight spread.
We'll give you a good price for your treasuries. and that's how quantitative easing comes about.
Yeah, the Fed will go to the dealers and say, we're a buyer, we want to buy $1 billion or something.
At a rate that people will accept.
Well, they'll look at the market for the 10-year note. In the U.S., maybe it's 244 bid, 243 offered. I mean, it's tighter than that, but we'll just say that's what it is. And the Fed will go to Morgan Stanley or Bank of America or somebody, and they'll say, I want to buy these. Okay, how high do you want to pay? Well, let's see if we can see how many we can get at 243, which is a normal market. So now the dealer goes in the market through the brokers or to their clients and says, the market's 244 offered, 2.43% offered, 2.44 bid. We're a buyer, we'll pay 2.43. Yeah, and then people will sell some there. And then the next market, and once they've bought all this for sale, now it might be 243 bid, 242 offered. And they'll go back to the Fed now, okay, what do you want to do now? And then maybe there's an announcement come out that the price of oil went up and everybody wants to sell all of a sudden. They don't really know it's the Fed. They just know Morgan Stanley has a buyer or seller.
So the people who are selling treasuries don't realize that they're selling them ultimately to the Fed.
Not at the time. They're not told.
So quantitative easing happens without people realize that they're taking part in quantitative easing.
They know the Fed's doing it, and they know there's a buyer, but they don't know in any individual transaction who's on the other side. You're going to get a few laughs out of that, right? People will be hysterical when they hear that. They'll be on the floor.
Yeah, that's fish and chips.
And then the Fed bought securities.
Bloomberg and Wall Street Journal are talking about MMT. What's happened?
I know. Interesting.
And it hasn't penetrated in this country yet. In other words, people don't. There isn't a sense that journalists in this country feel they have to talk about MMT, but it seems like MMT have swept the board of all the major journalistic. I mean, is there? It's almost like there isn't one that hasn't made its effort to kick MMT or something.
So what are they talking about here? Like, Newton just discovered gravity, or
One thing you described yesterday, Warren, was maybe it was Bill. He described how there was the sort of Scottish trade deficit with the rest of the UK. It's like 8% or something. And then there's also a Scottish government deficit of about the same
So I was
size.
using that to make the point that if you start your own currency, you're probably going to have a budget deficit. If you're going to keep that, then expect, for every $1 in tax, you're going to be spending $1.10. You're going to run a 10. That's because you've got this foreign, the same. But those numbers could change also. It's not, you can't.
But in the current, so at the moment, I think if I understand it correctly, Scotland's got that sort of twin deficit thing, the government deficit, trade deficit. Now, but the thing is, the government deficit, if I understand correctly, Tim, you might be able to correct me here. The government deficit at the moment is funded as part of the UK deficit. So money coming up from Westminster and then coming back down into the rest
So
of
it's not the local government that just borrows?
The Scottish government is not allowed to borrow.
So who does? The UK borrows for it?
The UK does.
So there's like a net transfer from the UK to the Scottish government.
Well, that's what they say.
Well, I mean, of course there is, isn't there? I mean,
Well, my question would be to the UK is if Scotland's losing so much money for you, why are you trying to keep it from leaving? What's your motivation for keeping it?
depiction.
No, the subsidy is going the other way.
Sorry?
The subsidy is going the other way. We're subsidising the south.
How is that?
Well, because the statistics are rubbish. There's no, the JERS figures, which everyone claims show that the Scottish government has a deficit, are back of a fag packet estimates.
So how do you know? Either way then?
Well, you don't, but
All right.
I think if we were a basket case that was being heavily subsidised by England, then exactly what Warren just said would apply.
Get rid of in the same sense, there's a transfer to the northeast of England and the northwest of England, and it's not about being a basket case.
It's very small. I can tell you. Yeah.
How do you know? What's the good data then?
Well, there was a very interesting set of statistics I came across, which is about government expenditure on capital investment. So, hospitals, roads, railway lines, things like that. Things which are funded by the state and which you can actually measure. So in 2016, the government capital investment in the Greater London area was £2,200 per person, and in Newcastle it was £20.
The cost to the central government isn't the funds they're spending. Those are just tax credits they're awarding them. And if they're more than they're taxing, they just remain outstanding. It's not a debt that they owe. They put it in securities accounts and they promise to allow you to switch it to a reserve account. So what? I mean, it doesn't take any resources away from them to let the bonds mature and give you cash for it. It's just the same thing. Bonds and cash, the government's all the same thing, right? So it's not convertible into anything, so you have no claim on their reserves. It's not applicable. It's the money supply. So whatever the money supply is in Scotland, the net financial assets have to come from the central government's deficit spending. Their job is funding the money supply for the whole UK. But to call that an expense is like, it's like if you had a national bus company and the center of the bus company gave all the bus companies bus tokens to use, so you didn't use money, and they were worth £2 each or something like that. And they said, okay, so we've given you all these tokens for £2. You owe us £2 for each token. Well, wait a minute, it costs them nothing, right? And you're doing it to provide a medium to run the company. That's not an applicable analysis. It's not a logically valid analysis. So the whole analysis is flawed from inception because they don't understand what the currency is or what they're doing when they spend it. What they're doing is using up tax liability, so they've got to examine relative tax liability and then decide whether in Scotland they're higher or lower per capita than ever. I think they're all about the same.
So with an independent Scotland and with Scottish currency, but if there's still an 8% trade deficit, I don't know if there would be or not. I don't know.
How would you even know? Why would anybody care?
With their own currency, it doesn't matter.
No,
but without the currency, it does matter.
The states in the U.S., nobody knows the trade deficit between New York and Massachusetts or Connecticut or Florida. Nobody cares. They don't care. But I guarantee if they started keeping track of it, somebody would care or do something about it and ruin a perfectly good economy with all kinds of trade barriers and everything else.
Is the implication not this? And it might mean there's no problem. I guess that's what my question is. But let's say there's an 8% trade deficit in an independent Scotland.
What's the trade deficit between Manchester and London? Yeah. Who cares?
But the thing within a country, you've got a flow going the other way. That if the problem, I think, which Bill was talking about yesterday, if we sit informally using sterling and we've got a net outflow of sterling from Scotland, and the inflow has now been cut off because we're not getting any deficit spending from Westminster, then we've got a problem because whatever the outflow is, eventually it's all gone and there's no
government. The private sector, the public sector.
Well, I mean,
where do we?
The Scottish government would replace that deficit themselves, wouldn't they?
But they can't if they don't have their own currency.
No. But if they have their own currency, then they can.
You need net exports to cover your financial assets. That's what you need. Any net financial assets you have, you're forced to net export. The same way Hong Kong is forced to net export. The currency board does that. Bulgaria is forced to net export by the currency board.
My question is this though: if independence happened tomorrow and the Scottish private sector continued to want to import stuff from the rest of the UK, which presumably they would, and there isn't a flow from Westminster anymore, and the Scottish government is now just doing the deficit spending to
So let's say you want to buy a Range Rover.
Yeah.
Where's that made? I don't even know.
Yeah.
Japan or something? No.
Yeah, probably not.
No, but let's say it was made in England, okay? And you're up in Scotland and you want to buy a Range Rover. You go to your dealer, they look at the exchange rate, they say, here's the price in Kilt, and it's 40,000. You decide whether you want to buy it. All right. Now, if the exchange rate changes, that might go to 50,000. It might go to 30,000, depending on the exchange rate. That's all that happens.
And that's a leakage out of the economy
or anything. It's just a different exchange rate.
But you're talking about with a currency. But if we don't have a currency,
if you just have sterling, it's the same thing. The question is, will you have a job? Will you have an income? Okay, and so your unemployment will be higher if you don't get your per capita share of deficit spending from the UK.
But that choice to spend money in England is a leakage from the economy, isn't it?
With your currency or not? With sterling or with Kilt?
If we have our own currency, it isn't. But if we don't have our own currency, it
It would
is.
have been if it was convertible into gold, because then they would take the Kilt, convert it into gold, and your central bank would run out and default. But it's not convertible into anything, so it just changes the exchange rate. Prices will just change depending on how much they, look, you're going to go to London with 100 cases of scotch, right, which is worth £50,000, and it's going to trade for a Range Rover, which costs £50,000, right? All right? No matter what your currency does, that 100 cases of scotch is still going to trade for one Range Rover. The question is who has to make the scotch and who gets to drive the Range Rover within your country, but that the terms of trade are not going to change, because that's an externally determined price. You don't determine that inside your country. Okay, and so all that, relative, you can have distributional issues. Fixed income people suddenly can't afford things, but people working in the export businesses, scotch production, whiskey production, they can. And so you have to have internal, and everything the government does is determines the distribution inside a country anyway. There's no natural distribution inside a country. It's all determined by your tax structure and what government pays and subsidies and all kinds of stuff in politics. There's no, it's always a creation of the state. They create all that. There's no reason a doctor should get 3 times what a plumber gets, or a plumber should get 3 times what a doctor gets. That's all based on the laws and contracting that the government does. The currency is their monopoly. They determine that. They don't even know they do, but they do.
So you're saying I suppose I always think of exporters as choosing to save in the importer's currency, and that's where I was.
No, if somebody, if the guy in India sells his company and decides to save in sterling, how can that happen?
So incongruous.
Okay, prices will adjust because of his savings. They'll have to buy them at a price that causes somebody in India to sell some auto parts to the UK and get sterling, and then he winds up with it. It causes our trade surplus, for that amount. Okay, and so our trade, differential for that amount, surplus for one, deficit for the other. Okay, if he decides not to do that, that doesn't happen. So it's these decisions to save or not save, to accumulate net financial assets, that then, through market forces, cause the trade to go the way it does. It affects the currency levels and to make it happen.
My question was going to be headed at, and maybe it's a misguided question. My question was going to be headed at: is there a chance that folk in England won't want to accumulate the Scottish currency, or is that the wrong type of question?
There you go.
They might not, and then in which case you'll have balanced trade.
That's when you get an adjustment.
Yeah, you'll have balanced trade. You won't, if it's $50,000 worth of scotch going to England, and you're getting one Range Rover, which costs $50,000, that's balanced trade. If you're able to get 2 Range Rovers because they not only want the scotch, they also want your currency, well, now you've got a trade deficit, which is good. But worst case, you're still going to get the 1 for 1. They can't take that away. What they can do is stop giving you extra stuff for the money, and that'll adjust prices in your country. Because you're going to allocate these resources by price, and so your internal institutional structure will decide. There's only 1 Range Rover instead of 2. Does that cause your local price to double now, or whatever? How does that change? Probably doesn't need to do that. Maybe a 5% move would change preferences, and people would live with 1 Range Rover instead of 2. But it's not that extreme anyway. You're not going to double your trade. It'll be a few percent. What's your total external trade?
It's about 70 billion a year. GDP is about 170, so about 40% of GDP.
The deficit's 8. So your running about 20%. If you lost your ability to run a trade deficit, your ability to net import would drop by 20%, or you'd have to export 20% more for the same import.
So the figures I've seen from the Scottish government there isn't a trade deficit. It's about zero. It's about equal.
Well, then nothing changes, except the distribution could change if the currency went up and down. But who gets it? Who can afford to buy it? Who makes the profits on the sales? That can change. But for the net wealth of Scotland as a whole, that's going to be the same. 100 cases of scotch is going to go out and a Range Rover is going to come in. No matter whether you have a currency or not, no matter what your interest rate is, your unemployment rate, they don't care. It just doesn't matter.
Is a problem with these kind of discussions is the direction of causality, because you're talking about people wanting to save the currency. Like they want to save the currency, therefore that changes the trade position. But I think it's more like...
It does. So if Barclays decide they want to hold Kilt,
yeah, right.
How does that happen? Okay, it means somebody in England, prices adjust, currencies adjust, so somebody in England sells something to Scotland and gets paid in Kilt, and they wind up with Barclays. And so you'll become a net exporter.
But sometimes it sounds to me like what we're saying is that somebody has feelings about a certain currency, like they don't want to save it anymore. And then
that can happen also.
Yeah.
But it's usually the central bank, like the Bank of China and Korea and Japan. They're all accumulating foreign exchange reserves. Why? Because those are the currencies they're targeting for export. Right. Once they've done that, the private sector can change it a little bit, but that's usually, they can do any size they want. So they'll target it. I mean, they'll just keep accumulating. They don't care. And they're, again, supporting their exporters. And it's to the detriment of their macroeconomy, because exporting is a cost. They have to work and build these cars and send them out. But the exporter doesn't care. He just wants to make his profit on whatever. He's exploiting his own population.
So it's about which lens do you look through? Do you look through it as the firm, or do you look at if you're looking through the country's eyes? It's like let's import.
The base case I look at is standard of living for the population. So it's a negative for that, but there's a minority gaining. Who would have thought? Look at President Obama was there. Made the statement the U.S. needs to consume less and export more. So you looked at our trade balance and everything else, just like Trump did, right?
Your analogy yesterday with the Romans and the Gauls was it you or was it Bill? So it was you, wasn't it? Was it you?
Yeah, when they conquered Gaul.
Rome
did sending stuff to the Gauls. I mean, that just cuts through everything, doesn't it?
You go shopping, the guy gets a better price. But so what was I just talking about?
Obama. You would say President Obama.
Obama. Okay, and then who becomes his chief economic? I'm still eating it. Do we have time?
Got about 10 minutes already.
Okay. The chief economic czar is Jeff Immelt, who's head of General Electric, the largest exporter. I mean, tell me what's going on here.
Who'd have thunk it?
No, Marx talks about the capitalists versus the workers, but today's exporter is Marx's capitalist, the way I see it. Because today's domestic capitalist, he doesn't care if everybody gets a pay raise because he's not at a disadvantage. He'll just pass it on like everybody else will. It doesn't hurt him competitively, and people have more money to buy it, and it's fine. And so back before we had exporters, like our car companies, they'd get together and one of them would negotiate with the labor union, and they'd wind up giving them a 5% increase or some whatever productivity was, and then they'd give it to all of them, and then they'd raise their prices. Everybody was happy. Okay, so that capitalist was not Marx's capitalist that was exploiting the workers. They were fine doing it. He was domestic only. But the exporter, he's not selling to these people. He wants them to get as little as possible, and he really doesn't care. So it's a whole different dynamic. He shouldn't even have a seat at the table. Never mind be named as the chief, economic advisor for the president for the whole country.
That was the MMT Podcast with Patricia Pino and Christian Riley. You can get in touch with us on Twitter at MMT Podcast, or I'm at Christ Riley, spelled ChristReilly. And Patricia is at Patricia N. Pino, spelled PatriciaNPino. You can also email me at christriley@outlook.com. Thanks for listening, and we hope to hear from you.